Hello friends, welcome to this July edition of Monthly Viewpoints. The rally in the Indian markets has continued for the fourth successive month in June. In fact, in the second quarter of this year, India has been one of the best performing equity markets globally. And in contrast to the narrow rally in US markets, where the top 5 tech stocks have largely contributed to the rally in the S&P 500, in India, the rally has been more broad-based with mid-caps and small-caps outperforming large caps. Continued momentum in macroeconomic indicators and return of the FII inflows have contributed to this rally. If you look at the underlying macroeconomic indicators, in the US, they are largely mixed even as the labor markets remain tight. The Fed continues to be hawkish and has guided towards 2 rate hikes in the remaining part of the year. However, we believe that we may see one more rate hike from the Fed with a long pause. Coming to India, the growth momentum continues as seen in the resilience of high-frequency indicators. The manufacturing PMI has come in at a high 57.8 and capacity utilization in the corporate sector has also crossed the long-term average levels. Current account deficit for the March quarter has also reduced, with a reduction in the trade deficit on account of stable oil prices and continued momentum in services exports. We expect to see the CAD being under control. India's forex reserves have risen to almost $590 billion with an import cover of 10 months, which bodes well for the Indian economy. Earnings growth also remains strong and is largely driven by the banking and financial services, auto and OMC sectors. For the first quarter of FY24, we are expecting strong earnings growth of between 25 to 30% year over year. And even for the full year FY24, the earnings growth is expected to be in the same range. Given the rally in the Indian equity markets, the valuations have risen and the 1-year forward multiple for the Nifty stands at around 19 times, which is around a 7 to 8% premium to the long-term average. India's premium to other emerging markets has also increased to about 60% versus the long-term average of about a 40% premium, indicating that valuation concerns can start emerging. In spite of this, we have seen FII inflows coming back. After $5.3 billion in May and $5.7 billion in June, just in the first week of July, we have seen strong FII inflows of almost around $300 billion. Given the slowdown in China, we can expect that inflows to other emerging markets like India can continue. Now, given the rally in markets, it's largely the earnings growth which may lead to a further uptrend in the rally. However, we may have to moderate our expectations from the equity markets going forward. And given the high interest rates, returns from fixed income are also looking attractive. Hence, our recommendation is that investors should maintain the equity exposure to median levels in their overall portfolio. And in fact, a multi-asset allocation approach where one has exposure to equity, fixed income, and commodities like gold and silver is the recommended approach. With regards to themes, we continue to remain positive on domestic focused themes such as banking and financial services, consumption, and domestic manufacturing. We offer a basket of funds for investors to choose from. Thank you and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
म्यूचुअल फंड निवेश बाजार के जोखिमों के अधीन है। स्कीम संबंधी सभी दस्तावेजों को ध्यान से पढ़ें।